June 8th, 2023, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at the UK housing market. I think the dam has broken, and excuse me for the analogy, especially with what's happened in the Ukraine, but I think it's a very good analogy. And I'm going to tell you why I think the dam has broken and why you're going to see a lot of news out there about mortgage companies pulling deals, increasing rates. And I've been warning about this, of course, since April last year. I have a series of videos of which I'm going to put in a playlist, and they're entitled "The Party's Over for UK House Prices." There's 4 of them, part 1, 2, 3, and 4. So before we go into the real estate or housing market or house prices, I'm going to talk briefly about the bond market, because a house to a banker or to a building society, when they lend to you through a mortgage, they look at your property as a bond. And what is a bond? Well, bond is just a loan. And it's a securitized loan. And what does that mean? Well, it means that the owner of that security can sell it in the secondary market. It's securitized. And that's all it means. So I think the major lesson here that people are going to be talking for years about what's going to happen, in my opinion, is that things never last forever. And you've probably heard many times in the last 10, 15, even 20 years that house prices always go up. And especially in the last 10 years that interest rates are going to stay low for a very long time. The Bank of England can always cut rates, do QE. That has been the mindset. But unfortunately now things are reversing, and as I said, good things don't last forever. But back to the bond market and why it's important to house price values. Let's say Building Society A lends to Mr. Smith £100,000 through a mortgage at 6%. That building society will be getting £6,000 a year from that £100,000 loan. But let's say that the government and the Bank of England drive down interest rates artificially, like they did from like 2008 at the height of the financial crisis up until 2021. They drove it down to 0, and some of the market rates are even negative, the 2-year yield in the gilts. So what that does is that mortgage Building Society A, instead of getting 6%, they're getting 1%. So they're gonna increase their lending, because if they don't, they go out of business. They won't have enough income to cover their operations and make a profit. So they'll start lending 200,000, 300, and even 600,000 once rates get to 1%, and they'll still be making that 6,000 that they used to make on 100,000. And that's why house prices have been driven up. Yes, we hear a lot about immigration and lack of supply, but those arguments are all going to be negated and are going to be shown to be a fallacy once we see house prices do what I think they're going to do. So this is why house values are going to go down, because interest rates have gone from almost 0 back in 2021. We're now approaching 5%. So Building Society A is almost back to where they can lend at 6%. And why would they risk lending at 600,000 or $1 million at 6% when they can lend 100 and get the same? Yes, they might lend a bit more because the cost of living gone up. So that's why house values are going to go down. And of course, the government and the Bank of England are going to do the most they can to stop this flood. Just like, unfortunately, the people of the Ukraine are having to be helped by the authorities there with the flood, with the break of that dam. This is going to happen. Am I saying they should help? Personally, it's a difficult question because they've pushed people into this situation. They pushed people during the lockdowns to buy a home. They drove rates down to zero. They did massive QE. They suspended the stamp duty, and now it's all unraveling. So that's why I think things are not going to get better. Yes, I see that a lot of people out there are forecasting house values to drop by 10 or 15%. I think that would be very optimistic. I think my best case scenario would be 30-40%. My worst case would be 80 or even more. It happened in Japan. It can happen here. And that will truly disrupt everything. It will disrupt not just people who have been loaded up on big mortgages and bought properties at very high valuations in the last few years. That will also disrupt people who withdrew equity from their homes to increase their standard of living because of the rising cost of living in the last couple of years. They extracted equity from their homes. They might end up homeless because the amount of equity they extracted might be more than the value of their homes eventually. It's gonna disrupt a lot of people in their 50s and 60s with their plans to sell their London property and then take half of it and buy another property and live off the rest. I think that's going to be something that is going to be just a dream that will not happen anymore. What's the positive, though? There is a positive. Well, the positive is that we're going to go back to reality because prices have been really not based on reality for the last 20 years, mainly because the central bankers and the government have tried to keep house values artificially high. They've kept interest rates artificially low at zero. We have we had the lowest interest rates in 5,000 years from 08 to 2021, according to Edward Chancellor. And I just got this book, which is The Price of Time, The Story of Interest by Edward Chancellor. I just started reading. I highly recommend it. You understand a lot of what's going on in the housing market by reading this book. I'm nowhere near finished, but I can see it's a good book. And I think he wrote it last year, or it was published last year. So as you can see, Edward Chancellor even gives you a little chart of interest rates in the last 5,000 years. And we are going to hear for years to come, or maybe forever, they're going to talk about this period where the central bankers and the governments went mad and manipulated interest rates to zero and even negative. So what we're getting now is the reversal. And the fact that this was the lowest interest rate environment in 5,000 years is worrying, because that means the correction is going to go through the mean, and it's going to be painful. Of course, it's not going to be painful for those who have been patient or who have been careful with their finances and didn't overextend themselves. They might be able to buy properties at fair valuations. So before we look at the markets, just wanted to show you the 2-year gilt yield and why I made that analogy that the dam has been broken. And I started warning back in April 2022 about the UK house prices. April 2022, and why that date? Well, because it was back then that we broke through that line, that trend line. And my background, of course, is in finance in the City of London. And aside from fundamental analysis, we did a lot of technical analysis. And when I saw that line break, I thought that was very significant. And that's why I started warning, because the trend that we've had since the early 90s of lower rates has turned. The question I had at the time was whether the reversal was going to be gradual or sudden. And as you can see by the chart, it looks very sudden. So that's why I think the dam has broken. This is a weekly chart, of course. We're breaking out on a weekly basis above the close that we had last year during the crisis. As you can see here, we've got today and tomorrow to come back below that weekly high from last year. I'm not sure we will. So I spoke about this a few weeks ago, that I could see mortgage rates in double digits by 2025, and it could be even before. Who knows? It seems to things seem to be getting out of control. And why is that? Why can't the Bank of England intervene? Well, because investors are losing faith in the Bank of England. They're selling these securities. They see that the inflation rate is still near double digits. Why would they want only a 3% return on their money if the currency has been debased by double digits? So that's why those rates are going up. This is really going to be disastrous, not just for the real estate market, but also commercial real estate, and also for credit card loans, consumer credit, because all these rates are based off the Bank of England rate, off the gilt rate. The gilt yields are considered the risk-free rate of return because it's what the government pays, and the government, of course, technically can print just to pay their way around. So I'm going to stop right here, and just wanted to say I'm not here to advise you on whether to buy a home, sell a home, get a mortgage. I'm just here to tell you what I see. You should do your own due diligence, your own homework. You should talk to mortgage advisors, financial advisors, and come to your own conclusion. And all I'm saying is that be careful when people say, oh, don't worry, rates are going to come back down, because I don't think they are. They will eventually, maybe in 20, 30 years, but the next few years is going to be difficult. So it's 8:45 a.m. London time. Let's quickly look at where the markets are this morning. We got spot gold at 1946. It's up just over $6. High's been 48, low's been 39. Silver is up over 1%. It's at 23.70. It's up 26 cents. We're right near the high. The stock market is virtually unchanged, so I won't go through it. The currencies as well are virtually unchanged, except for the pound is a little stronger here. It's up 0.2 at 124.50. Let's check the Antipodean currencies. Yeah, the Aussie dollar is up 0.5%, just below 67. Let's look at the dollar versus the Canadian dollar. Dollar is down about 0.2% at 133.47. I saw the Bank of Canada raise rates yesterday. They're supposed to have been on a pause, so that was a surprise. The Kiwi dollar is up 0.5% at 60.70. Let's quickly go through commodities. WTI crude is up 0.25%, 72.80. Brent is up 1/3 at 77.10. Platinum is up $7 at 1,030, and copper is up 0.2% at 378. Just a quick update on live cattle. Well, the dollar made an all-time low versus live cattle, or live cattle made an all-time high versus the dollar. So as you can see here, live cattle, that's how many cents per pound. So that means that with $1 right now you can get just over half a pound of cattle. I think that's just a reflection of currency debasement. There might be some factors related to that market that I don't know, but I mean, the overall picture is that the dollar is becoming weaker, I would say. Let's quickly look at the gilt market, of course. Well, the 2-year gilt yield is continuing to test that 460 level. Right now we're at 462. So the 475 level will be very important, I think, in the short term. If we can close back below 4.2 tomorrow, that would be a result, and it doesn't look like we will. So that will confirm that weekly breakout, which is a bad sign, I would say, not just for real estate, but for the whole economy. To the US bond market, the treasury market, we got the 10-year back above 380 right now. And yesterday we saw rates rise, yields rise. So it looks like bond investors are not comfortable with the central banks, and they're going to continue to sell bonds, and that's going to make things even worse, especially with news of this. U.S. Treasury's $1 trillion borrowing drive set to put banks under strain. Analysts fear scale of new issuance falling debt ceiling flight will push up yields and suck cash out of deposits. And these international markets, yeah, these are international markets. So this will affect mortgage rates in the UK because the US government needs to borrow. And I'm sure a lot of investors are going to think twice about lending to the UK mortgage market before they lend to the U.S. government at 5 or 5.5%. That's how this will affect the whole world, I would say. So with that, I'm going to wish you all a very good day. Take care. Bye.